Hey, Tyler, welcome to the show.
Hey, Simon. Good to be here, man.
Thank you. Thank you. Appreciate you making the time. I'm super excited to hear your story, but also just to talk about what's going on in the world. I mean, you're across a lot of stuff in M&A and as are we, of course, and just knowing some of the areas you play in, it's pretty exciting. So thanks for making the time.
Absolutely. You're welcome.
Buddy, I know we're going to talk about your business, Care to Continue, and then we'll get on to what you're doing today. But maybe just for a bit of context for the listeners, maybe you could kick off and just give us a little of your background and kind of what led to you starting Care to Continue, and we'll pick it up from there.
No, sure. Yeah. So I was an accountant by trade. So I guess the end of the story is circling back to that. But, ended up working for a gigantic bank as a middle manager. And I don't think as a college student, I would have identified myself as an entrepreneur. I just wanted to, but I didn't want to take orders. And when I felt like my work wasn't meaningful, I didn't feel like I was making a difference. Had an investor approach me and say, hey, we got a problem. I wonder if we can solve it together related to providing care for seniors. And so I ended up kind of stumbling backwards into the kind of healthcare staffing, nurses, CNAs, medical assistants. And I don't know what it's like in Australia, Simon, but in the States, there's this gigantic explosion of baby boomers that are needing care. And
definitely.
And there's in the insurance world, the health insurance world is bad in the States. It's not good. It's bad. We're great at fixing things that break a hip, we'll fix it. If you need a way to prevent getting into the hospital, we stink at it, right? And so I had a couple of grandparents that had a really nasty experience in a nursing home, and it just frustrated the hell out of me. I was like, I wonder if there's got to be some better way. And so that was the genesis of my business partner and I starting Care to Continue. We literally did this kind of fabulous over-the-top focus group experience with about 35 seniors. They named the company. It was their idea. So we kind of built our story out of how to really meet their needs better. And man, it was a hard first year. And then it was like a hard second year because we went from first year, nobody cared, right? No one cared about our business. Yeah. The second year, we went from 5 employees to 55 in like 11 months. And it was insane. It was insane.
That is a whole bunch of different problems there.
I know. And you laugh about it because we didn't make a lot of money, by the way. Like, so, that kind of growth was a really difficult thing to manage. And so we kind of over 3 or 4 years, 0 to 100 employees. And then I ended up exiting the business. And I think that's the part we'll talk about here in a little bit, Simon. But, we had some investors give us some really cool numbers from evaluation. And then my partner and I butted heads. And what ultimately ended up happening was not the dreamy exit that I had hoped for. It was less. It was great. It was base hit double, that kind of thing. Not a slam dunk, not a home run. And, started the business I'm in now called Seller Accountant, where we're helping. Now I'm trying to help the entrepreneurs in the e-commerce space avoid some of the mistakes I made. And we're seeing lots of cool stuff happen in the space in terms of exits for those guys.
Yeah, that's awesome, man. That's awesome. Well, and so much to unpack here, but healthcare, absolutely, right? I mean, we've got the wave coming, so the fundamentals of a business like that are pretty obvious. Yeah. I think, more and more, there's all these studies about how people don't want to go to some kind of sterile place to go and retire or live there. And, people want to be at home. They want to have, they want to be treated like a human. And there's all this sort of stuff going on around the lack of infrastructure facilities anyway. So, yeah, we are seeing the absolute same boom on that space. So that makes a lot of sense. But, rolling forward, you're saying about the first and second year and not making much money. Look, I get that too. I don't know what number, I'm on my 4th business or something like that. So, and I swear, I think I live by this idea that, generally, and I think you might have some e-com examples that blow this out of the water, but, typically I've said year 1, you pay for the business. Year 2, the business pays for itself. And then year 3, the business starts to pay you. Totally. And I've, So, and was that kind of similar there for Care to Continue?
Yeah, and I would even say that same 1, 2, 3 was the same for Care to Continue and the same for the second startup Seller Accountant, where not only did I pay for year 1, but it was lonely, it was terrible, it was scary. You're dialing for dollars and you're like, just I'll shine your shoes, I'll do your laundry, just give me money to do something for you, right? Yeah. And like you said, year 2, you've solved the first problem, which is, do people care enough to pay me to solve something for them? But then you got to build an operation around that. And so that's a real, that's a booger, because then it's like, oh, wow, we need to have a hiring policy, or, oh, wow, we got to actually figure out, like, we don't pay people consistently. Is there a salary range in our company, or that kind of stuff? And then, you skin your knees enough on that. And then, like you said, year 3, you're like, oh, I don't have to feel guilty taking a little money out of this business. We're not going to crash it tomorrow. It's funny, to your point about the e-commerce businesses. We saw a guy that, you're going to love this. He put $70K into a business. 18 months later is negotiating a $30 million exit with a private equity firm that has $1 billion in assets. Just unbelievable.
Oh, man. Good on him. Good on him. I have we had a client who sold in the middle of COVID too, and he started his business. In the first year, he took home $750K. And I'm like, and I swear, like, I didn't ask him his age, but I honestly thought he had to be just shy of 30. I thought he was still in his late 20s, and I'm thinking, man, you've done very well. I'll put aside my own sense of inadequacy here that I took 3 years to make some money. But anyway, he wanted to sell it. We talked to him about it and said, look, you need some more time. You've been in it 1 year. Like, people are just going to be very skeptical about whether this is repeatable. And he talked to me about his forecast, and he's growing and da-da-da-da. And I said, okay, cool. Go and do that next year. And then let's talk again, right? And so we helped him a little bit along the way. But the next year he took home 1.5. And we went, okay, I think you're ready. So, and we did sell it, and he got a good price, and, happy days. But look, I think the world is changing. That deal, by the way, went across in the middle of COVID. From the day we started the campaign, we closed it out, settled in 67 days. And, which was a record for us. But, and I keep telling people, that's not the norm. Don't expect that. So, hey, take me back to care to continue for a second. I'm curious because I want to cover that off before we get into the e-com stuff a bit more, because I want to spend some time on that stuff. I love it. Care to continue? Like, you mentioned that you kind of maybe didn't end the way you wanted to, but in the beginning, did you guys talk about your end game? Did you talk about exiting, all that sort of stuff?
I think so. We had lots of conversations, and they were. Actually, I've listened to a couple of your episodes. I'm not the first guy on your podcast that had like an older partner, right? I was the 29-year-old finishing grad school, didn't have 2 nickels, and was the only operating partner. And Dave was. I'm incredibly grateful that he would throw money at a 29-year-old and say, "Hey, go build something." So I think the big picture is just incredible amounts of gratitude. And so it wasn't just a handshake. We had a sheet of paper, but it assumed the most rosy, like to the extent, I'll give you an example. The initial contract that he had me sign paid me such an incredible percentage of our revenue as a bonus, because he didn't understand how to build a company, that I was actually the one 2 years in that said, hey, buddy, I'm bankrupting us both in the next 6 months if you don't renegotiate this and just give me a slightly larger piece of the company. I want this thing to grow. And so during the course of that transition was where we had his attorney in the room, and I think as 30-year-old Tyler thought that I had an agent in the room, and I just didn't. And so then, just like talking about taking some lessons from it, but we ended up saddling our balance sheet with a bunch of debt that was kind of to make him whole on the investment that he had made, plus a whole bunch. And that's a short way of saying I paid dearly for not being for kind of being a coward and not dealing with that conflict in 2014, right? I mean, again, in 2014 was the year we went from 5 bodies to 50. We're bringing in a lot of revenue. And I think in my head, I thought, you know what? Whatever issues we have, we'll scale out of that trouble. We're going to get to a point here where we're going to be making so much money. We're not going to know what to do with it. I'm not greedy by nature. We're going to be fine. And what ended up happening is that it doesn't work like that. We finally get to 5 employees. We're never a huge company in terms of revenue, but a little less than 260,000 a month in revenue, like that kind of thing. And cool. And it just didn't get better. And so what ended up happening is I was introduced to an investor that really understood our space at scale. He had run the $100 million version of what we were doing. And it was kind of perfect. This guy had money. His son wanted to get into something. And so he made us what I thought was an incredibly generous offer, given the fact that we were big, but we weren't crazy profitable. We were sloppy in our ops, $3 to $5 million valuation, bring him in. Yep. Make my partner whole. He was never active in the business. Make him really whole. Make him really happy.
Yeah.
And then I would have the active equity in an operating partner to move forward. And, in hindsight, I could see how he would, I could see how he would perceive me coming to the table with like, hey, I've got this really cool idea, as him being like, you're trying to cut me out of this baby that I helped you build. And, I don't know, it wasn't intentional, but in hindsight, I was probably a little bit aggressive on that side of it. Right. And so it just kind of eroded, some trust, I think, from his standpoint, where next thing I know, I'm having to let go of a key employee. Again, we got 105 employees. I'm a CEO of a company that's got a lot going on, and I got to let someone go that is his oldest friend that's in our company. And so now he's thinking, this is the one person in this company that could probably take over if Tyler decides to bail. Ain't happening. Not going to do it. And so I was the 25% owner. He was 75%. And, kind of the rest was history in terms of, I did sell it to him. It was a happy ending. I made a little bit of money. It wasn't anywhere near the $3 million valuation we had to begin with. And I did a 100-day CEO transition to a new team, which, by the way, was the most. Now, I've heard of some of my clients have these long earnouts, and it can be really awful. My 100 days of being like relegated to kind of being like a high-paid bookkeeper, sitting on the sidelines and kind of seeing this culture. I mean, these people I cared about so much just kind of eroding so quickly. And it was just gut wrenching. I was depressed. It sucked. It was really terrible. And so I was so thankful to see the end. Made a little money, grateful. I mean, I'm so grateful. Put a check in the bank, and then a bunch of small checks over the next 3 years, right? And then started something else. So that's the summary. I don't. You dig anywhere you want to. That's kind of what happened, man.
Yeah, no, thank you, and just appreciate your open and honesty here. It's it's one of those hard things where I think it takes a sense of emotional intelligence to be able to look back on ourselves and go, oh yeah, okay, I actually probably could have changed that or done better here, or I just plain screwed something up. And
yes,
I'm actually really good at it because I'm constantly pointing out to my wife, okay, I screwed up again. All right, I just got to own it.
Yeah, well, at this point, my wife just makes the face, and I'm like, all right, I know I screwed. I can't put my finger on what I've done yet. I'm not the smartest one out of the two of us, so it'll take me time to work this out. And thankfully, she's patient. Oh my gosh, yeah, absolutely.
So one of the things I've actually got a few clients at the moment, even that I'm talking to. They're going through different things, mergers and stuff like that, and I'm hammering the point almost to the point of like kind of pissing them off almost, where I'm saying, listen, You can't always map out and say, oh, in 5 years I'm going to exit at this valuation with this timing and this structure and like, we can point in the direction of where we want to go, but getting to the nitty gritty, we can't work that out. But you do need to have some mechanisms in place so that you and your business partners, if for some reason one of you wants to get out or two of the three of you want to get out or whatever, let's talk about that. Let's talk about that mechanism. And if somebody did walk in the door and made an offer, like if it's over a certain threshold, can we all just agree that that's a sale, or
Right.
So it's I guess from your experience, you probably have a different approach on, going into business with people, and maybe a different.
And I have partners now, by the way. Like I have two business now. I'm the dominant partner of this company. And that, it may be a while before I'm able to not be the dominant partner in a company. But I'm a big believer in partnerships. I'm a big believer in finding, talented people. But you mentioned some great things there. Like you can think you've done the work of kind of putting together a simple or even fairly robust operating agreement. But unless you have a clean kind of buy-sell kind of parachute kind of clause in there, because I think that's the thing. Listen, I mean, we're laughing about our wives, but like my intention is to be married for the rest of my life. If I can pull that off. But a business partnership is generally got a life cycle. And for most of us, that life cycle isn't like decades. It may be a decade. It may be some number of years. And so I think before you get into it too deep, first of all, this is what I wish I had done. This is maybe advice to myself, is have that conversation about what if somebody makes me an offer? What if one of us goes off the rails? What if one of us goes through a big family thing? I mean, just, because I think the rosy optimism that I brought into it, as again, I didn't know I was 29. I was like, you're going to give me money. This is great, and so, and so I think the wisdom now for future ventures is, hey, we need to have some possible awkward conversations, and we got to have them now. And if we can't have them now, and the other thing is kind of a big aspect of it is, how healthy are your partners? That was what I really wish that I had thought a bit more about. And this is not even to say that Dave wasn't healthy, but he had so much going on in his life that he needed this little fledgling business to perform, even though he was going to be passive. I don't know if that makes sense, but he wasn't so strong that he could let the thing kind of grow enough to really generate income. He needed it within a year and a half to generate income. And it really put some stress on the business that I hadn't forecasted. Yeah,
that's interesting, isn't it? I mean, it's all these sort of different dynamics that can just take people down paths they didn't even know existed, let alone, didn't think they'd find themselves on it. So it's, it's interesting. I think hindsight's such a wonderful teacher, but hey, we all go into things. The one thing that's uncertain is that there'll be uncertainty. So, it's having those awkward conversations, I think, is up front is a very, very good tip for anyone listening. And by the way, a problem you're having at a 1 million turnover, I love your point about you thought you'd scale out of it, but generally a problem at 1 mil turnover is a much bigger problem at 10 mil turnover. And even people who you didn't think were greedy at one point can become very money focused when the number is now substantial. So, I think start with the end in mind, right? It's one of those things, and having those awkward conversations is a very, very good idea. Mate, tell me a little bit about the when this party came along and offered money. Did they? I mean, you mentioned before, and I won't squeeze you too hard on numbers and stuff here because I'm sure some of it's confidential. But you mentioned that it wasn't hugely profitable, but 3 to 5 mil. I mean, that sounds like by a traditional metric, a multiple of EBITDA or something. It was probably a very good offer.
So I think, it was, and I am trying to remember the details because there was like the deal that didn't happen. But yeah, it was. I thought it was really generous. I mean, I think in that particular part of healthcare, we're not SaaS. It's not a software company, but I think there was kind of a 3 to 7x EBITDA multiple was kind of the standard in the industry, and the offer we got was very close to the top end. I think the investor was recognizing how dominant we had become in our region. So we were so for those of you who don't know the states, where the Georgia's in the southeast, Atlanta is the big city. And we were dominating the northeast side of Georgia that wasn't in Atlanta. And so we really had strong reach, and we needed cash to open multiple offices where we could really grow quickly. And so I thought we were getting kind of top of the market. I was expecting 5 and got like 7.5, like that kind of thing.
Yeah. Wow. Still, that is a great offer. And I'm just always sort of curious, one, about how do people come up with their numbers, right? So asking you about the formula is always really, really cool. But also really interested too in how this stuff comes about. I mean, I get a lot of clients come to me because they go, oh, look, I've been through this process. Someone tapped me on the shoulder and then I went down this long-winded path, and 9 months later they said, no, they're not interested anymore. So I'm always curious about where the buyer comes from. And so it sounds to me like, did they approach you? Did you just know them? Was it an older relationship? How did it come about?
I actually was at a kind of a trade show, a conference for our industry, and just, my grad school focus was kind of in finance. I just gravitated to some of the banker guys there just to talk to them. And I wanted to know what was happening in the space. And I also had in the back of my mind, for us to do the $80 million version of this company, I'm going to need some help, a lot of help. And so that's how I met the gentleman. And he was interested right away. And we met for lunch a few times in person and just spent some time together. And again, uncovered that he kind of had this dual position of being an executive in a private equity fund, having experience in my industry, and having a son that he kind of wanted to set up as a partner, maybe a minority partner in a firm. And so it was a really interesting strategic fit that we thought maybe it was coming together. Yeah.
Yeah, nice. And clearly, you feel the juice there. It's worth spending time on, right? So, yes. That's cool. Did you have any moments through that where you thought, geez, if this is going to happen, should I be going and talking to other people, or did the deal just feel so right that you didn't feel the need?
It's a really good question, because I think in hindsight, for sure. Let me just say this: the deal, I did it the wrong way in general. I had a 75% majority investor that was the main owner of my business, and so I thought that this was a really non-threatening thing to do, because I thought, hey, we're going to be able to really generate lots of value for both of us here. What I should have done is I should have had the hard conversation 3 years ago, kind of put some grievances on the table, let him do the same thing, and then say, hey, buddy, what may help us here is to work together, package this thing, and try to bring investors in. and then shop this investor along with 10 others. Right? I mean, there's a right way to do it. We maybe should have had a broker involved, that kind of thing. For me, that wasn't really on my mind. All I knew was we're growing 100,000 miles an hour. I need help. I was definitely in the let's work 60, 70, 80 hours a week. I mean, this is a 24/7, 365 business. And this kind of popped into my lap, and I'm like, well, I don't have anything else in my lap. This is cool. And so for my complete lack of diligence or even wisdom on that side, it was actually a fairly interesting relationship, but it was not handled the way I would advise my clients to handle it.
Yeah. Well, let's go take that step. It's a good segue. Talk to me a little bit about what you're doing these days.
So when I left Care to Continue, took my wife and 2 daughters camping for 3 days. And then the next Monday, got a laptop and a cell phone and started in another industry that I have no business working in, which is, now I am an accountant. I'm not a very good accountant. I'm more of a kind of finance MBA boy, right? But I just thought this e-commerce space, Amazon in particular, was just fascinating. And so we started a company called Seller Accountant. We sell a really non-sexy service called bookkeeping, right? You got to have it. And our kind of shtick is, let's help get you investor grade financials so that you can try to go to market and build your brand and exit when you're ready. And so it's become this really cool business. I love it. It's where there's I kind of feel like we're representing the Davids, these little guys that are competing with Bezos and the guys at Amazon or the Walmart guys. And they're, some of the same kind of clients, Simon, that you would work with, where these guys are doing it the right way. They're maybe $1 to $20, $1 to $30 million businesses. And if they can just get a few things in place, they can really have a life-changing exit. And so that's what we do. And so you and I were talking about a little while ago. It's like there's a supernova happening right now in e-commerce with just a ton, just in the States, like 10 billion in private equity, which is small relative to all private equity. But for Amazon businesses, it's huge. It has flooded the space. Values are up, multiples are up. And it's really been kind of an interesting moment.
Yeah, and just to sort of tag on to that, yes, in the e-com space, but for anybody who hasn't, for anyone who's been living under a rock over the last couple of months, M&A just generally, not just e-com, globally, it is, and in fact, I heard somebody the other day in the press tout this as the best time in history in terms of M&A. The interest rates are phenomenally low. Stock markets are phenomenally high. Properties are phenomenally inflated. People are looking for alternative investments, and that's going into businesses because it's the last area that they can get a decent return, and there is so much money flowing around. So, more deals, bigger values of deals, greater multiples are happening, and this is just broadly across so many sectors. So, for those who have been wondering, when is a good time to sell your business? Get your head out of your own business and your own backyard for a little bit and look up, because it's not necessarily about the ships in the ocean. It's actually the wave that's coming that controls most of the outcomes. And, really, if you listen to most of the pundits, over the next 12 months, you probably won't find a better time in the next entire business cycle. So ponder on that a little bit while I explore this more with Tyler. But, mate, you said to me, as we were jumping on the call, you've seen, and I hope I'm not saying anything too much here, but that you've seen about $100 million worth of deals flow recently, which is cool. Can you talk to me a little bit about what e-com transactions look like and just, the general flow for those out there who don't live in this space?
Sure, yeah, and we're hoping by the end of the year it'll be about 130 million. So there's a couple of other ones of our clients, and so, so what's happening is traditionally in e-commerce brands, we don't have a lot of, other than inventory. There's no physical assets. We have generated a product. Sometimes we have some intellectual property. Sometimes we don't. We're developing a Chinese supply chain. We're going to market via our website, maybe Shopify or Amazon, Walmart, that kind of thing. Mm-hmm. And so with this kind of supernova of private equity flooding the space, what used to be maybe a 2 to 3x multiple, and that was if you had a pretty strong brand, has
now
kind
that's
of become
EBITDA, just to...
Yes, I'm sorry. 2 to 3x of they're calling it seller discretionary earnings, but kind of an adjusted EBITDA for sellers. And it's become now a 4 to 5.5, right? So you think that's a doubling of the enterprise value, and these private equity firms are raising cash at 32x multiple.
Yeah,
and they're like, what 7? I got to pay 7. What's the big deal there? And so The challenge, and
Wow.
this is what's interesting, the challenge that some of these equity funds are running into now, and I've consulted with about 10 of them in the last year, is they underestimated the amount of working capital that was going to be needed to continue running these operations with some of the supply chain slowdowns that we've seen. And so they're still paying these high multiples, but the bill's coming due with their investors a little bit, where they're wanting to see some return on investment, and it's going to take a few more months than expected. And so in my side of the pond here, at least, that we're seeing a little bit of a temporary dip in the transaction volume here, kind of, I would say July through kind of October. And I think as soon as Q4 hits, which is, so again, if you happen to be in the e-commerce space, getting through a big Q4 here, and then maybe looking to go to market Q1, I think could be just fabulous timing, because even in the States, just in the States, another $10 billion in private equity is just feverishly looking to get into the space. They've got to, they imagine this, somebody strokes you $100 million check, and you have no choice but to deploy that capital within 6 months. And you have a very narrow investment thesis that says, I have to buy a business that looks like this, this, and this. That's kind of what's happening right now with our clients.
Yeah, no, I can relate to that. It's interesting, and it's funny too, because we talk about the timing in the market and all the rest of it. It's, the waves here, I hear people saying, oh, yes, this will be pushing all through next year and everything else. People are always trying to pick the turn of the market. It's like, man, you're never going to be able to pick that. Like, and the problem is you'll only know it's turned when it's too late. Yep. So, if you, once again, I think for people who are thinking about, should I be, I want to sell, or I want to sell at some point, you actually may get a better valuation today than you do in 12 months' time. So, it's don't hang around to start thinking about or talking about these things, because it takes time as well. So
I think I'd like to get your thoughts on this also, Simon, but I think it's so important. I'm increasingly convinced that it's important to kind of know what your number is, because I think because we can't time the market. We don't know, like, this theoretically, we'd love to sell our business at like 89% up the curve, and the other guy gets a little bit of good for 2 years, and then we've somehow captured all of the value. And it really doesn't work like that. And so if you got a number, if I know I need to make 5 million, if I know I need to make 10 million to get out, then it gives me a lot of power. And the other reason that's powerful is a lot of these equity firms will play games with the offers. They'll be like, hey, guess what? I'll give you an 8x multiple, but you got to throw in $2 million in inventory, and you're going to have an earnout over 5 years, and this and that and the other. And so, I mean, I'm sure you're seeing it more than I am, but like knowing your number and understanding that you can't spend a multiple, you can spend cash. Like, is that what you're kind of seeing?
Oh, look, absolutely. And I'll go next. We actually did a webinar on this sort of stuff recently, talking about how to come up with your number, right? Yeah. And I think too often I see with business owners, there's a bit of a thumb to the wind, and they go, oh, I think I need 5 million. And when I say, why 5 million? And they go, oh, well, that's just my number. No, how did you come up with it? And that's kind of where it ends. It's sort of like, well, I sort of did a bit of a back of the mental envelope and sort of went, 5 million, I'll pay off the house. I've got a bit left over, blah, blah, blah. That's my number. I'd encourage people to, this is your financial future, right? Like, this is a pretty important thing to spend some time on. And there are some really great processes you can go through to think about your life and where you're going and what's coming up for you, and how to put a little bit of science behind that number, and of course combine it with a little bit of business valuation science. I won't say magic, to understand valuations and how they work, so that you can kind of try to triangulate, right? Well, where am I? What do I kind of need it to be? Where is my business? What do I need to be doing? And you can start to then get a bit of a runway and say, well, you know what? With the right support and planning and whatever, maybe I can be at that number in a couple of years. And I think, Tyler, coming full circle back to what you're talking about, somebody walks in after 12 months and offers you that number, well, then it can be a pretty unemotional decision, right? Hey, we're in the Goldilocks zone. Let's do this.
Let's do it, baby. Yeah, and I 100% agree with everything you just said there, Simon. And then the only other thing I would add to it is, like, there's a little bit of self-discovery. Like, and this is just my personal story. Like, I think I was convinced when we were growing so quickly in our first company that my definition of success for myself was to be the CEO of a $100 million company with 500 employees and this, that, and the other. And I think what I learned through the journey was, that's maybe not me. That actually is maybe not how I'm wired. I actually might be a little bit more of I need to cash out at 5 or 10 million, and I need to go build something else. And maybe my life will be better served and I'll be more energized hitting a bunch of doubles instead of trying to hit a grand slam. And so know thyself as part of that scientific process can really go a long way.
Oh, big time, big time. And recognizing that, knowing thyself, your perceptions and your ideas and what's important to you do change, right? I got married and I realized my opinion was worth less. So, and that was a good thing, So, yes. I couldn't agree more. And, I've always laughed because I'm not the, I'm not the kind of guy who I need a Ferrari or this sort of stuff, or I need to have the massive luxury boat. I'd be happy just to go on the boat every now and again, right? Or, and here's Tim Ferriss coming through with the 4-hour work week. But, you don't need to be a squillionaire to have a really, really amazing life. And defining how you want to spend your time and stuff like that is going to be probably a far more valuable exercise as a human and as a business owner than pipe dreaming or blue skying about these things that you think you want. So
couldn't agree more.
Yeah. Tyler, what do you see with transactions around e-com? My experience has been, and I think partly this is because of the storm, M&A storm we're in at the moment. Partly, the COVID drove a big shift in thinking around business models. Some people, particularly private equity, have had parts of their portfolio smashed. There's big rethinks going on about how they solve those problems, but also, hey, if we're going to reinvest, we should be investing in different areas now, right, that are maybe more resilient or whatever. And of course, we all know e-com's been a massive beneficiary of that. So I'm prefacing what I'm saying with this explanation because I've seen some transactions. We've led some e-com transactions that have moved really quickly and done some cool things. But there is a big part of me that sort of goes, well, is that the norm? And so I'm curious to get your perspective around what a typical e-com transaction looks like, but also just your view on, do you think we're in a bit of a period where it's out of the norm, or do you think those kind of trends will continue?
I think what's out of the normal right now is the amount of new money in the space that hasn't matured operationally. So the things that are here to stay are you kind of alluded to this, Simon, but grandma wasn't going on Amazon.com or Amazon.au to buy her stuff. The pandemic forced her to start adopting that behavior. And so what was 30% year-over-year growth in e-commerce was like 60% and is going to be. So we kind of got a 5-year bump into the future. That's not going anywhere. The trend will continue. There'll be other disruptive players in there. I think what has really made it interesting from a financial standpoint, like you said, is those guys that were invested. There's a retailer in America called Kohl's or JCPenney that just got crushed last year. Let's take that cash out. We got to put it somewhere. Let's go into e-commerce because now we finally opened our eyes to the fact that this isn't a waste of our time. We want to get into it, right? But having smart capital, and I put that in quotes here, doesn't always equal smart capital. And so almost every one of these firms that I have had the privilege of helping, the first few deals that they try to diligence, they're just like, oh, we've got to win. We've got to win. We've got to win. Now, this is great if you're trying to sell your business, by the way, because these guys are looking for kind of cornerstone deals that'll help get them off the blocks. And they're willing to pay gigantic multiples, including maybe even some, like if you get a chance to roll equity with a firm that might go public in 3 years, that's how quickly these things are cycling. You may have a chance to really kill it. And we actually had a client that not only made $20 to $30 million in the first year of this exit, but was able to roll $6 million of that into this firm that Simon, I don't even know. I couldn't even calculate the actual final value these guys are going to get because it's going to be huge. And so I think what we're seeing, and this is what's interesting in the States here, is a number of these funds are already realizing, oh crap, I don't know how to run this business. And so some of the big guys are starting to gobble up the little guys. And so again, how does this apply to the normal business out there? I agree with your premise earlier that this is a really good time to potentially sell a business if you've got something that's really screaming along. And especially if you have a high risk profile, this is your only source of income. You don't have a lot of cash in the bank. Now may be a good time to take some chips off the table and use the reality. And you're not taking advantage of these guys. These guys are all like Harvard MBAs that have lots of money. If they want to give it to you to exit, take their money. And disappear and go build something else, right?
Totally. It's funny. I say the same thing to the other side. I've seen vendors who think that they can wave a magic wand over problems and they can just sell it to other people. And I keep saying to them, hey, those people are equally smart. Don't think you'll fool them either, right? So I agree with you. If they're smart guys wanting to offer you a lot of money, take it. I'd take it. You can always start something new.
Well, and also to your point there, this is what we saw this summer because we kind of had an anti-COVID bump. I don't know if some of your businesses have seen this, but we had some companies that really were disproportionately helped by the coronavirus pandemic here in America.
Yes.
Maybe they were like at-home fitness equipment or something like that just boom took off. And then they went to market with a trailing 12 months of May. They're getting the gigantic offers, huge offers. And the 90 or 60 days of diligence happened to coincide with a couple of months where they just went back to normal, just kind of tanked back down. And so one of these fairly large deals, fell through 65 days into diligence. And so the cautionary tale for me, I was like, and this is what I kind of heard you saying a minute ago, Simon, is if I've got systemic issues in my business, I'm not really going to be able to put lipstick on that pig and get it on the market.
Yeah.
I may want to slow down first of all, I always want to be the one to bring that issue to my buyer instead of letting them discover it. Because we also, my company does due diligence for some of these funds, like some financial quality of earnings. And I can't tell you how many times we dig in there and we're like, oh, here's another $100K in advertising expenses. Oh, oops, we just omitted that from the financials. And that kills the deal,
Yeah. Man, I totally hear you. It's I almost feel like a broken record saying this, but getting deals done is actually not an easy thing to do. It's not like selling a home where somebody walks in and says, "Oh, but I just love the kitchen and the local schools are so fabulous. Let's just give them an extra $50K." Like it doesn't happen, and there's so many complexities. And so you want a deal done. Well, you need willing buyer, willing seller who need to build an enormous amount of trust in a very short period of time. And as to your point, Tyler, little things like that, like actually some things might have been a genuine mistake, but that mistake, that issue gets blown up in the minds of the buyer because they will think it was intentional.
Yeah. And they start wondering, what else is he hiding?
Totally.
What else is in there that we're going to really not know until we get on the other side of this thing and we're going to be stuck with the bag? And so if you're looking for the opportunity to maybe have leverage to not have as much of an earnout and try to get more cash up front, just be transparent, be crazy. In fact, I almost encourage my clients to be like, that month, like last June, let me tell you about the 3 mistakes I made in June and how I really wish I'd done it better. I want to be like proactive in bringing those issues out because again, you can do the opposite. You can actually build trust in a way that they're like, well, maybe I should pay an extra half multiple for these guys. I mean, they're really good guys and they're not going to lie to us. This is great,
Yeah, absolutely. And I think too, we were saying before, buyers, they're going to be generally pretty smart people with pretty smart advisors. So they don't expect your business to be perfect. So the fact that you raise the issues with them and you can actually demonstrate that you've thought about it, perhaps you've learned something in hindsight and you've got ideas on how to mitigate those risks going forward, that's a big plus.
Yes.
Big plus. So, Tyler, I can see we're brothers from another mother, and I don't just mean because we're both follically challenged here, but
Great haircut.
Hey, I'm curious. Talk to me about a typical kind of e-com transaction. Like, what does that look like from a time frame? How much you go about sort of typically finding buyers? Are you leading those transactions? Or are you just mostly sticking to the DD part of it? What does all that look like?
So we are not an intermediary at this point. We're not a broker. So what we're doing is our role is that somebody comes in and we're cleaning up 24 months of financials so they can get through due diligence. And then we're normally, partnering with a couple of investment banker groups or intermediaries to help them get to the deal. And then in terms of the typical transaction, e-commerce tends to look like this. There's going to be, let's just say the multiples 4 times EBITDA or adjusted earnings. And then you're going to be looking at, normally the standard is maybe a 4x EBITDA plus a peg for working capital, meaning if I had $500,000 already tied up in inventory, the buyer will compensate me at closing for that inventory. The thing that's really changed is when you traditionally had to get the SBA, the Small Business Administration here in America, involved, the closing time was really long. If you could get it done in 90 days, you were really, really happy. Because the private equity guys are really geared towards pulling the trigger quickly, we're seeing a lot more deals kind of happen in 45 to 65 days, which is pretty quick. It's intense.
Is that from the beginning or is that DD? is that, sorry, I'm cutting across you there, but that 45 days, 90 to 90 days, is that from the beginning of the campaign, or is that the DD period, or?
No, that's probably at this point, if you've got your packet ready. So again, there may be 3 or 4 weeks of preparing your packet, but going to market, fielding offers. It's funny, a year ago, there was such a feeding frenzy. You might get an LOI within 5 business days, and you might be, doing 30 to 60 days of diligence, depending on the buyer, and you might be done. Yep. I think I'm seeing that lengthen a little bit. And actually what I'm seeing, Simon, is that these private equity guys, like, they are smart, and they're figuring out how to diligence the different nuances of the business model. For instance, am I more of an arbitrage play versus a brand owner? Do I own the IP? Am I more multi-channel or omni-channel, or am I really focused on one? And so when I asked them, and I would ask every single one of these funds, I literally talked to probably 30 of them last year. I asked them the same question: what is your strategy? And like probably 20 out of 30 didn't have one. They're like, they wouldn't say it like this. They could sell it, but their real strategy was to spend this money as quickly as possible, and we'll figure it out. But now they've matured a little bit because they've gotten burned on a few deals, and they're realizing, okay, we like the ones that look like this. For our industry, if it's a smaller number of SKUs that are really profitable, high moving, that's better than 1,000 different products that are kind of low moving because the net working capital is lower if you've got a smaller portfolio. And so most of those deals, let's say, just to finish my comment, if it's a 4X, you normally get about 3X at closing, and then either a stabilization payment or some form of earnout. But I do think that that's been a trend that's been in the seller's favor, where maybe 2 years ago, it was more 50% of deal value up front, 50% over the next 2 years. Now it is closer to 75% on day one. I think there's just a lot of leverage that the seller has right now, and the buyers are eager to get the deal done. And so I would not, if I were selling right now, I would not be happy having to take 50-50. And now, at least not if I'm in e-commerce. Like, there may be other industries where you got to do what you got to do. But if I'm in e-commerce, I want at least 70% on day one. And I want the earnouts to be really clear, so I know how to earn it.
Yeah, no, that's really, really great advice. And I think, for anybody listening to this who's thinking about selling their business, I mean, if you don't want an earnout, and hey, I get that, right? No one actually wants an earnout. Then you fundamentally, earnouts are there and put in place by buyers to mitigate perceived risks on their behalf, right? So if you want to avoid the earnout, mitigate the risk. So, if you're not selling today or in the next year, if you've got time to work on your business, there's lots and lots of things you can do to mitigate that risk. And clearly a big one of those is get yourself out of the business, and then they don't need you to hang around and do stuff. So there's plenty of things, and that's a discussion for another day. So, but yeah, Tyler, I'm so fascinated, I say, in this space, and I just love talking about this evolution of e-com. Are you seeing, because e-com's really broad, are you seeing any kind of trends in the styles of e-com businesses and what they offer?
There have been a couple of, I feel like there's been iterations, kind of the 1.0, 2.0, 3.0. 5 years ago, it wasn't that the joke, you could throw any garlic press in the world on Amazon and have $1 million business, right? There was no need to advertise, no reason to differentiate. You didn't even have to have your instructions in a language that was readable. And I think the market matured in about 2017, where having a differentiated product with an advertising strategy was crucial. All the other guys died. And now we're kind of seeing maybe version 3.0, where you really need to invest in your brand. You really need to do the work to, part of that mitigating the risk discussion you're talking about, Simon, is, do I have some assets that are, and I mean brand assets. I was talking to a guy the other day, it's surprisingly easy to get a design patent in America if you do some work to just tweak the design. And that gives you some real power to kick the bad guys off your listings if you're on a marketplace, or to have something on your own website that is more attractive. And so I think, here's my prognostication. My forecasting is that marketplace is going to continue to be king for the majority of products that are kind of commoditizable. In other words, I'm not trying to hate on your baby if this is your product, but unless it's highly differentiated and in a lifestyle kind of category, you're going to tend to get a better return on your ad spend partnering with an Amazon, eBay, Walmart. But the most profitable and highest multiple brands over the next 4 years are going to be the ones that have successfully crossed the chasm to have a true direct-to-consumer model, where they are selling to the customer through their website. They own that customer's email address and have now figured out how to retarget that customer. Because when you go to your investor now in 3 years, you can say, hey, listen, yeah, we got $1 million. We turn over $1 million a year on Amazon. We turn over $2 million a year on our website. But here's the even better part is whenever we launch a new product, I've got 250,000 email addresses that I can send a campaign out to direct that traffic to wherever I want to. Amazon, where do you want it? I'm going to send it there for you. And so just know that there is the ability to build additional asset value, but you can't be lazy. And it takes a lot of work to build that brand equity in those relationships. Yeah.
And, I don't want to say any more. That's brilliant advice. I just let that hang out there for a little bit. That's really cool. Tyler, clearly I could speak to you about this stuff all day. So I'm writing down here now. So I'm going to have to drop in on you when I'm back in the States next time. Man, are you happy for people to reach out to you? Because I imagine with what you do, it's not sort of US centric. I mean, helping people get their books in order and get prepared for DD is something that's universal, right?
Definitely. And especially, you're going to have a tax compliance guy in your country. Stick with it. Sure. You don't want my team. But if you're looking to address investors or exit in the States, which is where a lot of private equity is centralized, it may be worth looking us up. And so, selleraccountant.com. You can find anything you want to know about us there on the website.
Yeah, awesome. Are you happy for people to reach out on LinkedIn?
Sure. Find me on LinkedIn too. That's great.
Yeah, cool.
So Jefcoat with one F. It's the weirdest name in the world, but if you Jefcoat with one F, there's like 3 of us on the planet. I'm the bald guy that's 38. It's not hard to find me.
It's always the handsome ones, mate. Don't worry. We'll put links to your profiles, your websites. We'll put it all in the show notes for anyone who'd like to reach out to Tyler. And please, as we always say on this show, if you reach out via LinkedIn, don't just send a connection request. Please add a little note. Maybe let him know that you heard him being interviewed on this podcast, and then it doesn't sound so weird. Tyler, thank you so much. I'm going to have to come back to you and talk to you about coming on the show again because there's so much stuff here that we could keep talking about. But, man, I really appreciate your time. I'm really grateful for you sharing your story and just being so open with us. So thank you very much.
Simon, my pleasure, brother. Thanks for having me.